Some companies aren't flashy. In fact, they're just straight boring. But they pay real cash to shareholders and keep doing it year after year. Today I'm looking at two new stocks, which are Lowe's and Aflac, two steady names with simple stories and clear rules for risk. Hey, I'm Chris with Dividend Stock Scout. Each week I pick a dividend stock and explain them in plain English. I'll cover what the company does, the good things I see, the risks, the competitors, how I'll manage a trade, and why I passed my list. We'll finish each episode with a quick portfolio update for transparency and how we're doing, so you can see how we're putting our money where our mouth is. So remember, this show is for learning and fun, not financial advice. Please do your own research before you invest. And if you disagree with my picks, let's talk about it in the comments. Put some comments down there. I would love to have a conversation. So let's get started. So the first company we're looking at is ticker LOW, Lowe's Companies. I'll be honest, I'm not a big believer in retail stocks. They make me really nervous, especially when there's economic headwinds or things like these tariffs that we just don't know how they're going to play out. But for the types of companies I screen for, Lowe's checked all the boxes. Lowe's is a large home improvement chain. Regular people like you and I shop for paint, tools, appliances, decoration, home and garden items. They sell a lot of stuff. Lowe's also is catering more to professional builders. We'll call them the pros. They buy in bigger amounts of volume and they visit much more often than us regular shoppers. In May 2025, Lowe's actually raised its quarterly dividend to $1.20 per share, which means leadership has confidence in its cash generation. Lowe's also has agreed recently to buy Foundation Building Materials, which I will refer to as FBM going forward because that's a mouthful, for about $8.8 billion. That's a lot of money. FBM sells materials contractors use daily: drywall, insulation, metal framing, and they do it across roughly 370 locations. So this move is really about Lowe's putting more of the right pro materials in more places and being able to distribute it faster, which hopefully creates additional loyalty to Lowe's as a place for pros. So let's look at some of the data. So as far as a dividend yield, it's about 2%, which is $4.80 annually is what it breaks out to. Its next payout date we just missed because of the record date of October 22nd. Now, in the last 12 weeks, the momentum has been great at a roughly 7% over last quarter. With its 20 times earning, it is a great stock that is reasonably priced for what it does as a blue chip retailer. And the free cash flow you can't complain about at $7.8 billion. It gives them a lot of opportunity to grow, make sure that dividend is safe, and also will be used to fund future buybacks. Ultimately, I believe Lowe's is a good investment because it continues to pay and raise its dividend, supported by a really strong free cash flow. The company is making real moves to serve pros better, deeper inventory, broader assortment of products, and faster fulfillment via the FBM's network. That can make pro customers stickier and soften the impact of a softer DIY cycle from customers like you and I. Of course, there's always risks. Lowe's really still depends on the housing and remodeling cycle. If people move less or delay projects, sales can really slow. Integrating FBM when the acquisition is complete is going to be a big job. And connecting the systems, logistics, and teams, if it's bumpy, services to pros can hiccup before it actually improves. Now, competition always matters. Home Depot has been building a powerful pro ecosystem for a while. It acquired significant pro supply distributors, and it's raising the bar on its service, delivery speed, and selection. So if Home Depot executes faster, Lowe's may have to work harder on pricing and fulfillment to maintain that pro share. And let's not forget about the smaller hardware stores in your community, such as Ace Hardware. They compete with Lowe's in many regions and can hurt traffic locally, especially with their convenience and community ties. So something to kind of keep an eye on. As always, we're going to manage our trade. We always use a 20% trailing stop. So what that means is when I buy, I set the stop at 20% below my entry price. If the stock makes new highs, the trailing stop will actually move up to 20% below that new high, and it never moves down. This keeps small losses small and lets winners run. Reliable dividend growth, solid cash generation, and a credible plan to win more business with pros. It's not flashy, It's disciplined and it's smart investing. And that's why Lowe's cleared my screen this week. Moving on to number 2. All right, so we got AFL, Aflac. Aflac sells supplemental insurance, those extra benefits that people may want that help individuals and families when life brings medical surprises. A large part of Aflac's business is in the United States, but there's also a big part of it in Japan. Now, because of Japan, the yen, which is Japan's currency, can affect results. Management uses hedging to reduce those swings, but currency actually still matters and can impact Aflac, so something to keep an eye on. Heading into 2025, Aflac announced a 16% dividend increase to 58% per share each quarter, which is 232 per share a year. Another sign of commitment to rewarding shareholders. At $107 per share, the dividend yield is currently about 2.1% for Aflac. Now it's getting $2.32 per share annually. It's dependable, not huge. Now, its next payout is going to be, or its last payout, I should say, was September 2nd, 2025. And the calendars have an expected date of around December 2nd coming up with an ex date around November 20th. It's got roughly a 5% momentum, which is steady, nothing wild, obviously in the positive direction here for us. Its P/E ratio is about 24 to 25 times trailing earnings, which is richer than many insurers. So steady execution is really going to matter here because it is a little pricey. Now, again, my favorite metric that you'll always hear me talk about is free cash flow, and it currently has $2.45 billion as of spring 2025. Definitely enough to support dividends and buybacks, though this number can bounce with markets and claims as they arise. So just kind of keep that in mind. Now, I look at this as a good investment because Aflac's story is consistency, disciplined underwriting, regular dividend hikes, and a share repurchases that add value per share. With profits from both the US and Japan, the business isn't tied to just one market. Quarterly updates give frequent checkpoints on capital returns and currency effects, so we're able to keep an eye on this company and how it's being impacted. Now, we do have risks. Currency swings, as I mentioned. If the yen weakens, Aflac's Japan's earnings translate into fewer US dollars. Hedging helps, but it's not going to erase it. Competition. Aflac is in heavy competition with companies like MetLife, Prudential, Colonial Life, and others for employer relationships or broker attention. If rivals decide to push much harder with their pricing or provide richer benefits than Aflac can meet, Aflac may need to sharpen their offers, and that might put some pressure on their margins. So again, we'll manage the trade with the 20% trailing stop that only moves up with new highs. If the facts change or the price slides too far, we step aside and protect our capital. Aflac has that long history of paying and raising its dividend, steady operations through different economic cycles, and investor-friendly buybacks. It's not exciting, and that's exactly why it works. Now, normally every week at this point in the show, I will be showing you our portfolio. We'll show the buy price, the highest price since buy, the current price, dividends received, current 20% stop, and profit and loss. If a stop is hit, it's going to move into our cells with full honest results, including dividends. No secrets, just rules. And again, remember, I have real money on the table, so this matters. So keep an eye on this next week when we do throw out the portfolio update in our next episode. Now, if you like simple, steady dividend ideas with clear risk rules, hit subscribe, get notifications, and like this video. Thanks for watching Dividend Stock Scout. Again, this is education and entertainment only. Please do your own research before you invest, and I'll see you next week.